Let's talk about the everything bubble and why the market hasn't crashed yet. Because recently, some of the smartest and wealthiest people in the world have been making their predictions about why they think real estate is one giant bubble, that the stock market is a bubble, Bitcoin is a bubble, tech stocks are a bubble, EVs, SPACs, Tether, everything is just one giant bubble. The entire premise of this video is that making a prediction about a bubble doesn't make any sense without a date, because without a specific time frame, all predictions eventually become true. The best thing I can do as an investor who doesn't have a ton of money invested in the markets is just learn and listen. That way, I'm not selling off my investments based on fear. So in this video, I'm not gonna make a bubble prediction. Instead, I want to understand why guys like Michael Burry are saying the market will crash and why it actually hasn't yet. And why is this important? It's important because when you are constantly reading the headlines about market bubbles, it scares people, and sometimes that could be a self-fulfilling prophecy where people get scared, they sell, which leads to more sell-offs, which actually does lead to a market crash or worse. You just wait until the market collapses, but instead it goes up in value and you get left behind. So let's get back to the basics and make some sense. Hi there, my name is Ken. Here I talk about personal finance and investments. Today we're gonna try to understand why is everyone talking about stock market crash, but it hasn't crashed yet. Make sure to trade the like button and invest in subscription to the channel. You're also welcome to support the channel, all the links are down in the description. So anytime the market gets close to an all-time high, we talk about bubbles and how the market could potentially crash. In January of this year, when the Nasdaq was floating in the 13,000 point range, E-Trade sent out a survey to its millionaire investors. That is, people with over $1 million in their investment portfolio. They asked them whether or not they thought the market was in a bubble, and they got some really interesting responses. So 16% of the millionaires they asked said, yep, you are definitely in a bubble. The other 46% said we are in somewhat of a bubble. The other 29% said we are approaching a bubble, and only 9% said that we are nowhere near a bubble. But that was in January of this year, and there's been some new research to suggest that we might be in a bubble and why people are actually getting scared. If we take a look at the overall PE ratio of the entire stock market, which remember just fancy for price to earnings, how much is that stock's price trading at in relation to how much money it's making, with the high one meaning it's expensive and a low one meaning it's cheap. Well, just be careful not to get into the trap of buying low PE ratio stocks thinking they are cheap, because they don't tell you nothing about the quality of the company. So each stock in the stock market has their own unique PE ratio, but then the entire stock market has one too. And right now our stock market has a PE ratio of 37. Is that good? We don't know. We need to compare it against something because we need more context. So let's compare it against itself dating as far back as we could pretty much go, which is 1870. And since then, the mean has been 16.82 and the median 15.83. That means we are right now more than twice as expensive as we've ever been before throughout history. That's why a lot of these investors are coming out to try to warn investors that we could be in a bubble, and Michael Burry happens to be one of those people. Remember, Michael Burry was the guy that was represented in the movie The Big Short. Now you might not remember the movie, but you definitely remember this. So these banks started to fill these bonds with riskier and riskier mortgages. That way they can keep the profit machine turning, right? By the way, these risky mortgages are also called subprime. So anytime you hear the word subprime, think of, imagine if all finance videos were explained like that, we'd all be like the smartest investors in the world, right? So Michael Burry correctly predicts the subprime mortgage crisis that happened in 2008. But he was also one of the OG investors who discovered GameStop before it became a social movement. And here's what he recently said. He said, people always ask me what's going on in the markets. It is simple. Greatest speculative bubble of all time in all things by 2 orders of magnitude. So this is gonna be blow your mind, especially if you are a lover of Greek mythology, because pay attention to the detail of his Twitter handle. It's not Michael Burry. It's not his name, it's set to Cassandra. Who that? Turns out, Cassandra was a woman from Greek mythology that was once loved by the sun god Apollo, who promised Cassandra the gift of prophecy so that she could see into the future and be able to predict what would happen. Now Apollo was down bad for her attention, which is why he promised her the gift, but only if she reciprocated his love. She accepted the gift of prophecy, but she friend-zoned him anyway, and in return, Apollo cursed her with the gift of prophecy, but that no one should ever believe her. She correctly predicted the fall of Agamemnon, the fall of Troy, but no one ever listened, and that's why Michael Berry changed his name to Cassandra. It's his way of saying, I know the future, but you are just not gonna believe me. And I thought that was really cool, so ever since then people have been really paying attention to what Michael Berry has been saying, especially about bubbles. Anytime he says that, people listen. So the first thing he said is that the stock market is a bubble. So let's rewind. In 2019, Michael Berry said there was a huge problem with the index funds. Now, index funds are like the bread and butter of every investing strategy. It's like the cornerstone foundation of what investing was built on. Vanguard, by the way, is one of the biggest companies that has the biggest index fund. For example, VFIAX, which has over $40 billion in it. But all the index funds in the market represent 17.2% of all the money in the stock market. Trillions and trillions of dollars growing by the billions every single day because people just buy into them regardless of what they're worth. That's true for me, that's true for Andre Jake and Graham Stephan, it's probably true for Meet Kevin, it's true for a lot of people. Michael's main argument is that when you buy into something blindly, you remove the price discovery, which is just a fancy way of saying you have no idea what it's actually worth when you just buy it regardless of what it's worth. If you remember with Tesla, when it was just rumored that Tesla was going to be included in the S&P 500, the price just went sky high. But luckily for Tesla, that's a very highly traded stock. There's a lot of buyers, there's a lot of sellers. But some of the stocks within the ETFs are not as popular. They're not as traded every single day, there is less volume, there is less float, which means if the market was to ever collapse and index fund investors panicked and sold, there may not be enough buyers to meet their demand. And because there is a surplus of sellers and not enough buyers, the price would just crater. So what about Bitcoin? When it comes to Bitcoin though, it's been the best performing asset class in the last 10 years from 2011 to 2021. It returned an average of 230%, which is crazy when you compare it against traditional stocks, which only return 7 to 10% per year. The real problem with Bitcoin is that no one understands how to put a value on it, because Bitcoin doesn't make money like a traditional company does. And the reason that I think people call Bitcoin a bubble is just because it's a fundamentally new asset class that no one really understands how to put a number on it. Well, I'm trying to understand it because maybe it is a price bubble, but that's just what Bitcoin does. It goes to parabolic level and then it comes down to the previous all-time high. So for all we know, Bitcoin could very well crash to $20,000. That's just what it does. But actually, that's also the price you pay for 230% annual returns. That's the price, it's volatility. If you can ride the roller coaster, if you can stomach it, then you'll make a ton of money. I can also see why some people think Bitcoin is a bubble, because people buy Bitcoin regardless of what price it is, exactly like index funds. So we remove price discovery, but does that mean that we shouldn't invest in index funds and we shouldn't invest in stock market because it's a bubble? No. If anything, the real risk with Bitcoin is the stablecoin market, like Tether for example, which in some cases is like having an unregulated license to print an infinite amount of money, which is then used to pump the price of Bitcoin in crypto, which is kind of what happened in 2017. But each new cycle that happens within Bitcoin, each new high and each new low, makes Bitcoin stronger because now the supply is decreasing as more corporations and hedge funds and retail investors and even countries are starting to use it and add it to their balance sheet. Is Bitcoin's price a bubble? Who knows? The price I think will continue to crash upwards long term. I don't think it's a bubble. I think it's far from it, but unfortunately I won't know if I'm right or wrong until at least a few years from now. So just set a reminder for this video and check back in a few years. But on top of all of this, there's another billionaire investor by the name of Jeff Green who made a huge amount of money in 2008 when he predicted the subprime mortgage crisis also, and he predicts that the real estate market is also in a bubble. Jeff Green's argument for why real estate is in a bubble is because the government flooded their economy with a ton of money, and he thinks 80% of the price appreciation in real estate has been because of this fiscal policy, and the other 20 is because of actual fundamentals. And there's definitely research that supports what he thinks, because the price to income and the price to rent ratios are pretty much the highest they've ever been. He also cites the famous lumber price index, where the price of materials and pretty much everything is at an all-time high, and how long can that really last. And what he thinks is gonna happen is, he thinks we're gonna have a huge runaway inflation to the degree that no one ever imagined, which is gonna force prices to go through the roof, which will then force the government's hand to step in and cool everything down by increasing interest rates, which should then in theory correct the prices. That makes a lot of sense actually. Then the question becomes, why hasn't everything crashed yet? Here's some thoughts. When it comes to buying anything, especially real estate, if it makes sense today, then buy it today and don't wait, even though people are afraid for the exact same thing. People know that real estate is high, but it makes sense if they are financially stable. They have the money to pay for it, and even if the price of the house crashed, they could still live in it. And that's the beautiful thing about real estate, is that its utility doesn't change with price. When it comes to stocks and crypto or anything else like that, as long as your dollar cost average over 10, 20, 30 years, none of it will make any difference in the end. Just remember, different asset classes have different explanations for why their bubbles might potentially pop. Like the one that I'm concerned about the most is the student loan debt crisis, which is a good example of a bubble that I thought actually would pop a long time ago. When will students realize that they shouldn't be forced to pay hundreds of thousands of dollars for a degree that doesn't guarantee them a job? Maybe a year from now, maybe 10 years from now. I also don't think that real estate is in a bubble like it was in 2008. Even though lumber, steel, and other materials are pretty much at an all-time high, it doesn't necessarily mean it's gonna affect everything if the price of those go down. It might affect only the new home sales and not necessarily the real estate market. When it comes to stocks though, when it comes to specifically momentum and social movement stocks, maybe that will collapse when people forget about their diamond hands and the narrative changes and people just get bored and they forget about it. Or maybe because the FINRA reported the margin lending is at an all-time high this year, which means institutions are taking on way more risks. But the point is, every different asset has a different factor and different catalyst and a different story to tell for what could happen. But not a single factor is responsible for the collapse of the entire market. And even if the market does collapse, one thing is still true. Papa Powell will swoop in, buy up all our assets, QE, and infinite money glitch us out of trouble. Because if the world's biggest pandemic in our lifetime was not enough to take the economy down permanently, then what will? Maybe we're living in historic times where we'll never see a big correction. Well, I don't think that's gonna happen forever. I still think we'll see a healthy correction of 10, 20, 25, maybe 30% in the nearest time or next few years in 2022 or 2023 when interest rates go up. But my biggest question is for all the people making bubble predictions, how much does the market have to go up by before they admit that they were wrong? Is it 10, 20, 30, or is there never a point of which they say, at least to themselves, we were wrong, and maybe their prediction stands forever until they eventually end up being right? Either way, the thing I always remember is this. If you invested $10,000 into market in the last 20 years today, you would have something like $30,000 to your name, which is pretty cool, and that's if you only kept that money invested without selling. But if you try to time the market because you read some scary headline and you accidentally missed the best 10 trading dates, you would have half as much money, $15,000, all because you missed just 10 of those days in the last 20 years. But if you missed the best months, you would have even less than you started with only $6,000 to your name. And if you missed the best 60 days, you would have only $2,000. And the crazy part is that the best days come right after the worst days, because 6 of the best 10 days came 2 weeks after the worst days, so that's something to think about. It's kind of scary, but I think it should be encouraging to just leave the money in the markets and remember that the next time somebody makes a prediction about a bubble, that it's completely useless unless it has a time frame, because eventually every bubble prediction will come true. As always, don't forget to trade the like button, invest in subscription to the channel. Love you, thank you so much for watching this video. Here are more other videos about personal finance and investments for you. I hope this helps you. I'll see you back here on the next video.